What's going, guys? Hope you're having an absolutely fantastic day. So a lot of people have been panicking about the real estate issues that we are having in the US, right? So specifically commercial real estate, right? So basically a lot of people see this as a slow moving train that's going to get into an accident, right? And the accident being the commercial real estate companies and also the banking sector, right? So in this video, I thought we'd take a look at Howard Marks's thoughts on commercial real estate and also a little bit of asset values, right?
So that's a great segue. I'm going to move into commercial property. I hear you've been making the media rounds bad-mouthing commercial property, so we're going to delve into this a little bit. So I think we all acknowledge rates are higher, liquidity's lower. REIT prices were down 25% last year. Non-traded REITs were up. We had
Okay, so basically that's the first weird distinction that you have to make, right? REIT prices, which is publicly traded real estate investment trust, right, are all down across the board last year, right? But what happened is the privately traded market of REITs are still up, right? So that's a first dispersion, right? And that's maybe a first red flag in the commercial real estate sector.
Had a discussion earlier in our segments that while, to your point, Howard, while the public markets are a pretty perfect leading indicator directionally, with regard to magnitude, as you say, they tend to overshoot and undershoot. So, but REITs were down 25% last year. Core was up. Bid-ask spreads are wide. Transaction activity has cratered.
So a brief explanation to anyone that didn't understand what he's saying. Basically, he's saying that the private real estate market is getting more illiquid, right? And what being more illiquid and the bid-ask spreads that he's talking about is like, let's say I'm a seller and I'm only willing to accept, let's say, 100 million from my property. But on the other side, there is a buyer, right? And the buyer is only willing to pay, let's say, 60 or 70 million. So you can see that there's a 30% spread, right? And that's a huge spread, right? And this is one of the issues with privately traded assets, right? They can market at any price, right? And basically, some people will market at the last price that it was traded, or some people will market as, mark to market. But the thing is, if the market is illiquid and there's no transactions, right, technically you can market at any market price, right? And your balance sheet might be overinflated or something like that.
I think cap rates are starting to rise, but it's hard to tell with a lack of transaction activity. Moving to the real estate mortgage market, $4.5 trillion market, about 700 or 800 billion matures each of the next 4 or 5 years. A third of loans are floating rate, and a lot of multifamily and some office. And again, probably need to inject 500-600 billion over the coming years to maintain loan to value. So I guess I'm asking what your opinion is of that market, and where do you see opportunity?
Well, I believe that, as I said before, when interest rates go up, the notional value of all assets goes down. And last year we saw the fastest increase in interest rates in history. The Fed funds rate went from 0 to 4.5 in 9 months. Never been anything like that before. And at the same time, psychology swings from, I always say that in the real world, things fluctuate between pretty good and not so hot. But in terms of investor psychology, it goes from flawless to hopeless. And, we're on the way. We've made nobody thinks the outlook is flawless anymore. I don't think anybody has accepted that it's hopeless, and I don't know if they will. But certainly, psychology is more moderate today than it was. So
I think I'm just going to take a pause and talk about what he's talking about, right? Psychology goes from flawless to hopeless, right? And that's really, really important, because if you think about it, right, if psychology is at a point where everything is hopeless, we have to sell all our assets, right, which he doesn't believe we have reached that point, right? If we reach that point, that would be a great time to pick up assets, right? But even before that, if any assets like that you value, right? And this is something that I'm also trying to learn, right? Because we tie macro into our thinking by accident or on purpose, right? That, you know, if the assets fall below a certain value, right, it doesn't matter what the macro is or whatever, right? As long as you understand the asset and you understand the cash flows that it's going to produce, right? And you understand that maybe it's not affected by the macro, right? You can buy the asset anyways, right? It doesn't matter if macro changes and the asset collapses even more, then you can buy even more, right? And that's something I'm still trying to wrap my head around, because to us, right, investors, right, maybe sometimes we expect everything to come down together, right? Let's say the regional bank failure, why isn't everything going down together, right? Big tech was still climbing during the regional bank failure, right? So that is something to think about as well.
Have higher rates depressing value, you have a negative swing in psychology, and then in certain sectors you have a real deterioration of fundamentals, long-term fundamentals, maybe office. Right. And certainly, as you said before, certainly office that's not great properties. Old or ill-located or, right, or something like that. Now, nobody can say whether the 25% decline of REITs is appropriate, not enough, or too much. But you know, anything which has...
I think this is something that is very interesting for investors, right? You look at the way he talks, right? Even though he has a certain outlook, right? He is not certain, right? Okay, that's two different usage of certain, right? He's not sure, right? So because you as an investor, your job is to keep an open mind, right? Because things can change, right? And maybe the information that you look at is no longer valid.
Hasn't been marked down is suspect.
Right. In the financial crisis, the peak to trough for REITs, 72%. So if REITs are an indicator at all, you know, to your point earlier, the magnitude versus 08, 09 is substantially different.
But those are publicly traded REITs. Yeah. Now, one thing I want to...
I think this is where he goes into another point, right, where he talks about privately traded and publicly traded, the difference between the assets, right? So some closing remarks would be that Howard marks things like the privately held assets maybe are not so accurate of their marking, right, their values. But also he says that it shouldn't be the same way of marking the values on a private asset than a public asset, right? Because every year you have to mark your assets if you are a private company, right? If it's owned privately, right? Any private assets, let's say you have a real estate company or whatever it is that has private real estate, but you are traded, let's say, on the public markets or something like that, you do have to mark your private assets, right? So what he's saying is not necessarily because the public market trades the real estate at a certain price means you have to follow, right? Because the public market REITs went down 24% doesn't mean you mark down your portfolio 24%, right? So that's what he's trying to say. But these are also very weird and fluid situations, right, where accounting games can really get the best of investors, right? So maybe that's like a warning of something you should look out for if you're buying REITs or something like that, right? But yeah, that's about all I wanted to share this video. If you did enjoy the video, do help me smash up the like button, hit subscribe, and also hit the bell button. With that being said, have a fantastic day ahead and peace out.